Imagine paying every single rupee of tax you owe, getting a totally clean bill of health from your accountant, and then, still receiving a notice for a massive 10 lakh rupee penalty 2 years later.
Yeah, that is a terrifying thought.
Right. And you're crying for this, literally just leaving a single box blank on a form.
Which happens way more often than people think.
Exactly. And today, we're looking at a scenario exactly like that, drawn directly from our source material. It's this highly practical guide by Ankita Shethia, and it's all about foreign asset disclosures in Indian income tax returns.
Specifically focusing on ESOPs. Right?
Yes, employee stock option plans issued by foreign companies. So the mission for you listening to this deep dive today is pretty straightforward. We want to help you understand the mechanics behind these disclosures so you can, avoid life-altering penalties for simple compliance misunderstandings.
Because the penalties are severe.
Oh, they are. I mean, getting penalized for an undisclosed asset that hasn't even made you any money yet. It feels a lot like getting a speeding ticket when your car is parked safely in your own garage.
That is exactly what it feels like. It's a jarring reality for so many taxpayers. I mean, you aren't being penalized for how fast you were going. You're being penalized because you didn't register the vehicle properly while it was just sitting in the driveway.
Man, that is frustrating. So how does an empty box trigger a formal tax notice?
Well, to understand that, we have to look at the underlying mechanics of India's taxation model, specifically the shift toward residence-based taxation and how that combined with the Black Money Act.
Right. And for you listening, assuming you're familiar with the basic concept of being an RR, a resident, an ordinarily resident, the core principle is that your financial borders effectively disappear.
Exactly. They vanish.
The government isn't just looking at what you earn in Bangalore or Mumbai. They are taxing your global income.
But the crucial pivot here, the element that really catches people off guard, is that this principle extends way beyond income. It extends to the mere holding of assets.
Just holding them.
Just holding them. And the catalyst for this intensive scrutiny was the Black Money, Foreign Income and Asset and Tax Implementation Act of 2015.
The Black Money Act. I mean, the name itself sounds like it belongs in a spy novel or something.
It really does.
It conjures up images of secret offshore accounts and money laundering, right? Not like, a mid-level software engineer holding a few shares of the U.S. tech company they work for.
And that is exactly the philosophical disconnect we're dealing with. The law was originally engineered as this heavy hammer against intentional large-scale tax evasion.
Right.
But to map illicit funds, the government realized they couldn't just look for secret cash transfers. They had to cast a net wide enough to capture a total, exhaustive map of global wealth held by Indian residents.
And the little guys get caught in that net.
Precisely. The unintended consequence is that this massive dragnet now routinely captures everyday employees holding foreign ESOPs. What's fascinating here is that the reporting mechanism is mandatory regardless of whether those assets generated a single rupee of income during the financial year.
Okay, logically, this breaks my brain a little bit.
How so?
Well, if no cash has hit my account, like I haven't sold the shares, I haven't received a dividend, the stock is literally just sitting there as a digital line item on a brokerage screen, what exactly is the government tracking?
They're tracking potential.
Right, but if the asset is dormant, why does it need to be flagged every single year? It feels like having a dormant volcano in your backyard that you have to register every year.
I like that analogy. Because the government views an asset not just as current wealth, but as potential future income, and a vehicle for wealth transfer.
Oh, okay.
Think about it. If they only track the income when you finally sell the shares and realize a profit, they completely lose visibility over the asset's life cycle. They want the entire map of your global holdings from the absolute moment of acquisition.
So when it does make money, there are no surprises.
Exactly. So that when the asset eventually generates income, the transaction is already anchored to a verified origin point. It's all about establishing an unbroken chain of custody for your wealth.
Okay, well, if just holding an asset triggers rules originally designed to hunt down black money, we really need to understand exactly what the government considers a foreign asset.
It's a broad list.
Yeah, the source lists 10 categories, but instead of walking through them like reading from a textbook, let's group them by the underlying logic.
Good idea.
It seems like the government is looking at 3 main buckets, right? Financial interests, physical assets, and the most surprising one, control.
That is a highly effective way to categorize them, actually. The first bucket, financial interests, is pretty straightforward.
Stuff like bank accounts.
Yeah, foreign bank accounts, brokerage accounts, trusts where you might be a beneficiary, and of course foreign equity or debt. This is the bucket where your foreign ESOPs live. The government wants to see the liquidity and the investment vehicles.
Right. And then we have the second bucket, which is physical assets. The source mentions immovable property like a house abroad, but also movable capital assets. So wait, if I buy a valuable painting or, I don't know, a vintage car, and I keep it at a friend's house in London, the government considers that a disclosable foreign asset.
They absolutely do, because physical assets represent parked capital.
Hmm.
But the third bucket you mentioned, control that, is where taxpayers frequently stumble.
Yeah, this one is wild to me.
Specifically having signing authority in a foreign bank account.
Right. So if my company sends me to their Germany office for a 6-month project and they give me signing authority on a corporate expense account just to, pay local vendors, none of that money is mine.
Doesn't matter.
Wait, really? I have to report that on my personal Indian tax return.
You do. If you're an RRR resident, the authority to move money across borders is treated with the exact same level of scrutiny as actually owning the money.
Yeah.
From a regulatory standpoint, control over capital is a potential vector for wealth transfer. If they don't track who has the authority to move funds, the entire transparency framework just falls apart.
Okay, let's unpack this. We have this vast definition of foreign assets. Let's bring the focus specifically back to ESOPs and the mechanism used to track them. The dreaded Schedule FA, or Foreign Assets Schedule.
Yes, Schedule FA. It is the primary disclosure vehicle, and let me tell you, it is meticulously detailed.
You can't just check a box.
No, you cannot simply state that you own shares in a U.S. company. You must provide the foreign entity's name, their address, the nature of the asset, and the exact date of acquisition.
And the financial valuation part is where the administrative burden really kicks in, right? Because you don't just write down the dollar amount.
Far from it.
Yeah.
You are required to report the initial cost of acquisition, converted into Indian rupees.
Okay.
But more importantly, you must report the peak balance or peak value of that asset during the year and the closing balance, all converted to INR.
I noticed that detail about the peak balance in the source. Why does the government care about the peak value if it just fluctuates all year anyway?
It's basically a mechanism to prevent intra-year evasion.
Oh, like hiding money temporarily.
Exactly. Before the peak balance requirement, an individual could theoretically move funds into an offshore account in April, use those funds for 11 months, and then just empty the account just before March 31st.
Sneaky.
Right. If the government only asked for the closing balance, the account would look empty and the asset would go completely untracked. Tracking the peak balance ensures that any significant concentration of wealth during the year leaves a permanent footprint on your return.
Okay, that makes perfect sense from an auditing perspective, even if it is a total headache for the taxpayer.
Yes.
So Schedule FA tracks the asset while it's just parked there.
Correct.
But eventually, you want to actually make money from these ESOPs, and the source outlines a 2-stage taxation trigger for that. To help visualize this, I like to think of it like a fruit tree.
Let's unpack that analogy. How does the fruit tree map to the two tax events?
Okay, so stage 1 happens when you actually exercise the options. It's like your employer giving you a highly valuable fruit tree, but at a massive discount.
Okay, I'm with you.
Let's say the tree is worth $50 out in the market, but you only pay $10 for it. The government looks at that and says, hey, your employer just gave you $40 of value.
Yes, the perquisite.
Right. They treat that difference, that $40 perquisite, as salary income, and you are taxed on it immediately at your standard slab rate.
And that highlights the primary friction point of stage 1, which is the liquidity trap.
Yes, because you don't have the cash yet.
Exactly.
Yeah.
You now own a valuable asset, the tree, but you haven't actually generated any cash. You still have to find the liquidity from your own pocket to pay the Indian income tax on that $40 perquisite value.
Exactly. I have the tree, but my wallet is empty.
It's a tough spot.
Then we move to stage 2, which happens years later when you finally decide to sell the tree or, sell the fruit it produces. This is the capital gains stage.
Great.
If the foreign company's shares are listed and you hold them for more than 24 months, it is a long-term capital gain taxed at 12.5% post-budget 2024. If it's shorter, it's short-term capital gains.
But the crucial mechanism to understand here is the cost basis for stage 2. To avoid double taxation, the government does not use the $10 you originally paid.
Oh, thank goodness.
Right. They use the $50 fair market value from stage 1 as your starting point, so you only pay capital gains on the profit made after the day you receive the tree.
Okay, so we have the theory of double-stage taxation, but the actual filing process, it is an absolute alphabet soup of forms.
Oh, it really is.
We have Schedule FSI for foreign source income, Schedule TR for tax relief, and the most notorious one, Form 44.
Form 44 is where the system truly tests a taxpayer's resilience.
Why is it so bad?
Well, if you exercised your ESOPs and the foreign government, let's say the U.S. withheld taxes on that transaction, India allows you to claim a foreign tax credit via Schedule TR, so you aren't taxed twice on the exact same income.
Which is great.
It is, but you cannot claim that credit without filing Form 44.
And here is where we hit a massive logistical nightmare that the source really hints at.
The calendar mismatch.
Exactly. The U.S. tax year runs from January to December. The Indian financial year runs from April to March. How on earth are you supposed to get a finalized tax certificate from the IRS proving you paid the tax in the U.S. in time to file your Indian return by July?
You often can't. And that calendar mismatch is precisely why so many people fail at this step. It creates a massive structural bottleneck.
So what do people do?
Taxpayers are often forced to rely on interim withholding statements or just employer documents because the formal foreign tax assessments just aren't ready.
Yeah.
And the rule is unforgiving.
Like zero flexibility.
Zero. Form 44 must be filed online before you submit your actual ITR. If you file the ITR first and then realize you forgot Form 44, your claim for the foreign tax credit is instantly invalidated.
Man. So it's a double whammy tax-wise, plus an administrative obstacle course. It's like paying to enter the amusement park, paying again to ride the roller coaster, and then if you fill out the wrong form at the entrance, they just kick you out of the park entirely.
That's a painfully accurate way to look at it.
Furthermore, you're entirely locked out of the simpler tax forms, right? If you hold a foreign asset, even a single fractional share of a U.S. company, you absolutely cannot use ITR-1 or ITR-4.
Correct. You are forced into the much more complex ITR-2 or ITR-3. And using the wrong form render your return instantly defective.
It is such a rigid system, and to see how easily someone can stumble through this maze, the source provides a highly relatable case study. Let's look at Ria.
Ria's story is a classic example.
Yeah, so she is a software engineer working at the Indian subsidiary of a U.S.-listed tech firm. In the 2024-25 financial year, she decides to exercise 50 of her vested ESOPs. Her employee strike price is $5 a share, but the fair market value on the day of exercise is $30 a share.
Right, so the stage one math is pretty straightforward here. She has a $25 perquisite value per share. That's the $30 minus the $5 she paid.
Yep.
Multiplied by 50 shares, she has $1,250 of perceived profit.
Now, Ria has to convert that $1,250 into Indian rupees to report it as salary. And the source makes a very specific point here, which I found fascinating. You cannot just Google the exchange rate.
Definitely not.
And you can't even use the RBI reference rate on the day of the transaction. You have to use the telegraphic transfer buying rate, the TTBR, from the State Bank of India, specifically as of the last day of the preceding March.
Yeah, the underlying logic for mandating the SBI TTBR on a specific date is all about standardization.
To stop people from gaming the system.
Exactly.
Okay, so Ria does the conversion correctly. What she should do next is report that amount as salary, list the 50 shares she is holding in the Schedule FA, file Form 44 for any U.S. taxes paid, and submit everything via ITR-2.
But the reality of information asymmetry kicks in here.
Right.
Ria assumes that because she hasn't sold the shares for cash, there's no final income to report. She thinks, I only have my standard Indian salary, so she just files an ITR-1.
Oh, no.
She skips Schedule FA completely, and she completely misses Form 44.
Boom. She triggers 3 major compliance violations on a single return. And the source outlines several other common traps, too. A huge one is the assumption regarding TDS, or tax deducted at source.
This is such a common trap.
Yeah, people see that their employer withheld some shares or cash to cover the exercise taxes, and they just assume the reporting is done. Taxes paid, I'm good.
And that is a dangerous assumption. TDS merely satisfies the immediate tax withholding obligation. It is just a payment mechanism.
It doesn't replace the paperwork.
Not at all. It does not replace the requirement for granular, schedule-level reporting on your personal return. Your employer is telling the government money was paid, but it is your legal responsibility to map exactly where that asset sits.
Another trap I find fascinating and honestly terrifying is the role of chartered accountants. We all assume handing our documents to a CA absolves us of risk.
It doesn't.
All right. Ankita Shethia's guide explicitly notes that even seasoned CAs make mistakes with ESOPs if the client doesn't provide the right paperwork.
Think about it. A CA is ultimately reliant on the data you provide them. If you just hand them your standard Form 16 and bank statement, they have zero visibility into your foreign equity portal.
They don't know what they don't know.
Exactly. To file correctly, they need the original grant letters to understand the vesting conditions, and they absolutely need the official FMV certificates to establish the correct cost basis. If you don't declare the dormant asset to your accountant, they cannot register it for you.
Which brings us to the most urgent part of this whole discussion. Let's say you listening realize you accidentally pulled a RIA 3 years ago. You didn't declare your vested shares. Are you doomed to pay the Black Money Act penalty?
The 10 lakh rupee penalty.
Yeah, which the source notes is a staggering flat penalty of 10 lakh rupees per year. I mean, that penalty alone could wipe out the entire value of the shares an average employee holds.
It is a severe penalty, and as we discussed, it stems from a law built for billionaires hiding illicit wealth, not software engineers making a paperwork error.
Right.
But the good news is, the government has recognized the sheer volume of these non-malicious errors. In the Finance Bill 2026, they introduced the Foreign Assets of Small Taxpayers Disclosure Scheme.
Also known as the FAST scheme. Here's where it gets really interesting. This is a massive lifeline. It basically gives defaulting taxpayers a strict 6-month window to voluntarily disclose their past foreign assets and clean up their record without facing the full wrath of the Black Money Act.
It's a game changer for so many people.
Let's look at how the tiers are structured, because it reveals a lot about the government's priorities here.
Okay, so the scheme divides taxpayers into categories based on the nature of their omission. Category A targets SSEs who fail to disclose their foreign income or asset entirely, with a total value up to 1 crore rupees.
So people who just completely hit it.
Exactly. The regularization cost here is steep but quantified. It's a 30% tax on the undisclosed amount, plus an additional 30% levy acting in place of the massive standard penalty.
So Category A is still a significant financial hit. But Category B seems vastly more forgiving.
It is.
It applies to people who actually paid the required tax on the income, like Mr. Viraj from our opening example, who paid his capital gains but simply failed to fill out Schedule FA. If their asset value is up to 5 crore rupees, the penalty drops to a flat fee of just 1 lakh rupees.
That structure is a direct acknowledgement by the tax authorities that a blank box in Schedule FA when taxes are otherwise paid is an administrative failure, not an act of tax evasion.
Such a relief.
And there is a further concession. If the non-disclosure is related to foreign movable assets valued up to 20 lakh rupees, the scheme waives the penalty entirely.
Wait, really? Zero penalties?
Zero. And, crucially, starting October 1st, 2026, utilizing this scheme grants total immunity from prosecution under the Black Money Act for these specific disclosures.
Wow. It is essentially the government saying, look, we know the forms are complicated and our giant net caught the wrong fish. Let's get everything out in the open, update the ledger, and just start fresh.
Exactly. But this raises an important question. The risk, however, is complacency.
How so?
The FAST scheme is only open for 6 months. Once that window closes, the temporary amnesty evaporates and the draconian 10 lakh rupee annual penalty risk returns in full force. The burden is entirely on the taxpayer to initiate this correction.
And that is exactly why we wanted to explore this source material with you today. Let's distill all of these complex threads into a rapid recap of the 4 non-negotiable rules you need to carry forward.
Okay, rule number 1. Disclosure does not equal taxation. Schedule FA is a tracking mechanism. It must be filled out every single year you hold the foreign shares, even if their value drops, and even if you haven't realized a single rupee of profit.
Perfect. Rule number 2. Remember the fruit tree analogy for the 2 tax events. You face Stage 1 taxation on the perquisite value when you exercise the options, treated as salary, and then you face Stage 2 taxation on the capital gains only when you eventually sell those shares.
Right. Rule number 3. The foreign tax credit is an illusion unless you follow the procedural steps. If foreign taxes were withheld, you must file Form 44 online before you submit your ITR to claim the relief.
And finally, rule number 4, the moment you hold a foreign asset, even a fraction of a single share, you graduate from the simple tax forms. Never, ever use ITR 1 or ITR 4. You must file using ITR 2 or ITR 3.
Adhering to those 4 principles will shield you from an immense amount of financial and legal turbulence.
Absolutely. So here is our direct call to action for you. If you have ever been granted ESOCs by a foreign company, or if you hold any asset that might fall into those broad categories we discussed, take some time this week to pull up your past tax filings.
Check for Schedule FA.
Yes, check for it. Call your CA, and when you do, provide them with your actual grant letters, your vesting schedules, and those FMV certificates. Make sure you utilize the Budget 2026 Fast Scheme window before it closes.
The cost of ignoring this, even accidentally, is simply too high to justify.
It really is. We will leave you with this final thought to ponder. If tax compliance for a middle-class employee holding a few foreign shares now requires tracking the precise SBI exchange rate on a specific day in March, perfectly timing Form 44 across mismatched international tax calendars, and navigating laws designed for international money launderers,
A lot.
it's insane. How is this system going to survive the next decade? As global remote work becomes the standard, and borderless compensation via global equity becomes the norm for millions of workers, won't this completely break our traditional rigid definitions of a resident taxpayer?
It's definitely going to force a breaking point.
The rules will inevitably have to adapt to a borderless workforce, but until they do, the burden of proof and the risk of that empty box falls entirely on you. Thank you for diving deep into these sources with us today.